You know that feeling the game is rigged against you, but you can't quite prove it? You just found the proof. Your index fund was quietly turned into a wealth transfer machine. From your pocket into the pockets of people who already have more money than they could spend in 3 lifetimes. And the part that's going to make you genuinely angry, this wasn't done in the shadows. It was done with a rule change, official, documented, approved in a meeting. And almost nobody covered it. You weren't hacked. You were legislated. You spent years doing everything right. Index fund, monthly contributions, long-term vision. You trusted the system because the system made sense, and now the system changed its own rules. Without asking you, without warning you. SpaceX was just the first case, the test run. They took a company that lost $5 billion last year, rewrote the eligibility rules of one of the biggest indexes in the world, and within 15 days forced hundreds of passive funds to automatically buy that asset. With your money, without your consent. And it worked. So now comes OpenAI, Anthropic, an entire line of companies bleeding money at industrial scale, with a wide-open path into the index you're using to build your retirement. You're not the investor in this story. You're the exit liquidity. That's the exact phrase a portfolio manager said in a room full of Wall Street bankers. Your 401k is the exit liquidity. Your retirement account is their way out. The insiders sell. You buy, automatically, not out of naivety, by design. If you've been feeling like something was off with the market but couldn't put your finger on it, this channel exists exactly for that. Serious financial analysis, no conflicts of interest in plain language. If that's worth something to you, subscribe and drop a comment. Did you already suspect your index fund could be used this way? Before we go any further, I need you to understand one thing. This video is not about SpaceX. If you walk away thinking the problem is SpaceX or that the problem is Elon Musk, you missed the whole point. The problem isn't the company. The problem is what the company exposed about the system. When someone picks a lock for the first time, the problem isn't the lock picker. The problem is that the lock can be picked. And once everyone knows it can be picked, everyone with enough motivation is going to try. SpaceX picked the lock, and now there's a line forming outside the door. In May of this year, NASDAQ quietly changed 3 fundamental things. They cut the waiting period from 3 months down to 15 trading days. They eliminated the minimum float requirement, and they created a hidden multiplier that treats a company's real float as if it were 3 times larger than it actually is. 3 changes, approved in silence, with perfect timing. SpaceX was targeting June with a float of 4 to 5%. Under the old rules, automatic disqualification. Under the new rules, it gets into the index in 3 weeks, with its float counted as 3 times bigger. Too convenient to be a coincidence. OpenAI is eyeing the public markets. So is Anthropic. Both are going to show up with the exact same setup, astronomical valuations, massive losses, and now a rule book perfectly calibrated to fast-track their entry into your indexes. NASDAQ didn't rewrite the rules for one company. It rewrote them for a class of companies. SpaceX was just first in line. These companies have the best lawyers, the best bankers, the best lobbyists money can buy. When the rules shift in exactly the right direction at exactly the moment they need public capital, that's not luck. That's leverage. That's how power actually works in financial markets. And the retail investor doesn't have a seat at that table. Never did. Why is a company losing $5 billion a year valued at nearly $2 trillion? Because the valuation doesn't need to reflect reality. It just needs to be high enough at the moment passive funds are forced to buy. That system is live right now. Let me show you exactly how this works in practice. Forget finance for a second. Think about an auction. You're in a room. There's a painting on the stage. The serious buyers ran the numbers and concluded the asking price makes no sense. But then the auctioneer changes a rule. Everyone who walked into the room is required to place a bid. Doesn't matter if you want the painting. You're in the room, so you buy. And there's more. Every bid gets calculated as if each person has 3 times more money than they actually do. What happens to the price? It shoots up, artificially, before anyone can process what just happened, and the seller walks away rich, before the price crashes back to where it should have been. That's exactly what's happening to your index fund. When a company gets added to the NASDAQ 100, every fund tracking that index buys automatically. It's not a decision, it's a mechanical execution. The algorithm rebalances and the money leaves your account. You don't vote. You're not consulted. Over 200 investment products, $600 billion in assets. When a company enters, that entire mountain of money moves in the same direction, at the same time. That's not market demand, that's manufactured demand. Here's the exact sequence. Every step exists for a reason. First, high-profile company, astronomical valuation, operating losses, goes public with a float of 4 to 5%. Second, under the new rules, qualifies for the index in 15 days, before the market has any real time to question the valuation. Third, passive funds are forced to buy. Tiny float plus massive demand, price gets artificially pumped. Fourth, insiders are watching that inflated price with a countdown clock in their heads. The lockup ends eventually, and when it does, they sell. Fifth, when insiders sell, the artificial pressure is gone. Price starts reflecting reality. And who's left holding the bag? You, through your index fund. That bought automatically, without asking you. This isn't a conspiracy theory. It's financial engineering within the bounds of the law, with official documentation. And one more layer most people miss: the float multiplier. When NASDAQ treats the float as 3 times larger, funds allocate more money than the company's real size would ever justify. It's like a fake weight on a scale. You pay for what it reads, but what it reads isn't real, and nobody tells you the scale is rigged. Now I need to ask you an uncomfortable question. If all of this is real, why haven't you seen it all over the major financial news channels? Why didn't Bloomberg lead with it? Why wasn't it on the front page of the Wall Street Journal? Fair question, simple answer, and a disturbing one. It's not that they don't know. It's that knowing and publishing are 2 completely different things when your biggest advertisers are the same investment banks coordinating the IPO. There's no secret backroom. There doesn't need to be. Bias doesn't have to be explicit to be real. When your business model depends on advertising from financial institutions, when your analysts are regular guests at events sponsored by the same banks you're supposed to be covering critically, you develop a finely tuned instinct for framing stories in ways that don't rock the boat that keeps you afloat. That's not censorship. That's incentive. Invisible and way more powerful. But some things leaked through anyway. George Noble, a portfolio manager with decades of market experience, said it publicly, in terms that leave zero room for interpretation, that the American investor's 401k is the exit liquidity for the SpaceX IPO. Not a metaphor, a mechanical description of what's about to go down. The Financial Times, through its Alphaville section, where the serious analysis lives, away from the headlines, has been covering the inconsistencies in SpaceX's valuation in stark contrast to the silence from the rest of mainstream financial media. Independent analysts and researchers without conflicts of interest are arriving at the same conclusions. The valuation doesn't hold up to serious analysis. The timing of the rule changes is impossible to explain as coincidence, and the retail investor is sitting in the most vulnerable seat in this entire structure. That consensus exists. It just doesn't show up where most people go looking for financial information. This isn't the first time. CDOs before 2008, the dot-com bubble. In every single one of those moments, the voices naming the problem were called pessimists, and the retail investor was the last one in and the last one out. The pattern is recognizable. And recognizing patterns is exactly what separates people who understand the market from people who just participate without understanding the rules. The market was never built to be fair. It was built to be efficient. And efficiency means money flows toward where power is concentrated. The problem isn't that the system is broken, it's that it's working exactly as designed, and you're on the wrong side of it. Everything we've talked about so far has been structural, mechanical, systemic. Now I'm bringing it home. NASDAQ rules and float multipliers are abstractions. What isn't abstract is the money you're putting into an index fund every single month thinking you're building something. A retirement, a cushion, a way out someday. That's exactly the money sitting at the center of this story. There are two types of people watching this right now. The first type is under 40, still in the accumulation phase. When they hear the system changed, the reaction is almost intellectual. There's anger, there's outrage, but there's emotional distance because retirement still feels far away. If that's you, your pain isn't immediate. It's corrosive. It doesn't show up on next month's statement. It shows up 10, 15 years from now, when the asset that got loaded into your portfolio without your say-so has performed exactly the way the fundamentals always suggested it would. Badly. The second type is 5, 10 years from retirement. Every single percentage point of return matters in a very concrete way now. A severe correction at the wrong moment isn't an inconvenience. It's a life plan rewrite. If that's you, what we're talking about isn't theoretical. It's a direct threat to the timeline you've spent years building. The timing of these rule changes is particularly brutal. You're sitting at exactly the moment when you need the system to work as advertised. But there's one pain that hits the same for both groups, the pain of having no say. You could be the most financially informed person in your entire family, done all the reading, made all the right calls, and still, if your money is in a fund tracking the NASDAQ 100, you're buying SpaceX. You're buying OpenAI when its turn comes. You're buying every company that squeezes through the new rules. Not because you chose to, because the mechanism chose for you. It's not just financial risk, it's the loss of agency. It's realizing the tool you chose to control your financial future has a built-in logic that operates completely outside your control. SpaceX targeting $2 trillion in valuation, float of 4 to 5%, under the multiplier treated as 3 times larger. Tens of billions in automatic buying compressed into 15 days, while insiders are still fully in, waiting for exactly the right moment to walk out. You get pushed in. They walk out on their own terms. That's not a timing coincidence. That's timing architecture. This kind of analysis changes how you see every IPO that hits the headlines. If this video is opening your eyes, drop a like. That's what gets this content in front of more people who need to see it before the next IPO lands. This is the moment where most videos on this topic completely drop the ball. Either they sell you a miracle fix, buy gold, go all in on crypto, get out of the market right now, which is basically trading 1 risk you understand for 5 you don't. Or they stay stuck in doom and gloom with no way out, leaving you feeling like just another helpless victim. Neither one is honest. Neither one is useful. I'm not going to give you financial advice. What I'm going to give you is worth more. Clarity. The right questions. Because information without direction is just anxiety with more details. First question, what exactly do you own? Most people know they have an index fund, but have no idea which index it tracks, what the top 10 holdings are, or how concentrated those positions are. If your fund tracks the S&P 500, the dynamic is different. It has profitability requirements that create a barrier the new NASDAQ rules don't directly cross. If it tracks the NASDAQ 100, you're standing on the front lines of everything we've discussed. Second question, how concentrated is your exposure? The NASDAQ 100 is already heavily concentrated. The top 10 holdings account for more than half the entire index weight. When SpaceX gets in and OpenAI comes after, that concentration increases in assets with sky-high valuations, operating losses, and insiders with every incentive to time their exit perfectly. How does your exposure change if 2 or 3 massive IPOs enter the index over the next 12 months? Third question, what alternatives exist inside passive investing? Bailing entirely is rarely the right move. Transaction costs, capital gains taxes, Market timing risk. A full exit is way more expensive than it looks on the surface. But inside the passive universe, there are options with very different characteristics. Funds with profitability requirements screen out exactly the kind of company we've been talking about. Funds with geographic exposure outside the U.S. market don't carry direct exposure to the NASDAQ rule changes. Fourth question. The most important one. What's your time horizon? 20 years or more. You have time to ride out corrections. The damage is real but manageable. 5 years or less. The math changes completely. A forced entry into overvalued assets right when you're about to need those resources is a timing risk that deserves serious attention right now. If your financial plan was built before May of this year, it's worth revisiting with this new variable on the table. Knowing this doesn't make you immune, but it changes your expectations. You won't be blindsided, and it changes your questions. Better questions lead to better decisions. Not perfect, better. Which is the most any honest analysis can ever actually deliver. So let's recap what you know now that you didn't know when you hit play. NASDAQ's rules got rewritten, not for one company, for a whole class of companies. The waiting period dropped from 3 months to 15 days. The minimum float requirement was eliminated, and a hidden multiplier artificially inflates the index weight of any company that comes in with a small float. SpaceX was the test, and the test passed. OpenAI is coming. Anthropic is coming. Every company that shows up with the same profile, astronomical valuation, operating losses, controlled float, is going to use the exact same path that just got paved. Your index fund is going to buy, automatically, without asking you, and the insiders are going to sell, strategically, at exactly the right moment. This isn't theory. This is the mechanism operating right now, documented, approved, already in effect. But I want to leave you with something that goes beyond the mechanics. The most common reaction when people wrap their heads around this kind of structure is anger mixed with resignation. Anger that the system works this way. Resignation that there's nothing to do about it. Resignation is the most expensive thing you can take away from this information. The market has always had information asymmetry. There has always been a gap between what people with access know and what the retail investor knows. That gap has never been zero, and it probably never will be. But it shrinks every single time you understand one more layer of how the system actually works. You made it here. You understand the mechanism. You know which questions to ask. You know where to look when the next big IPO shows up in the headlines with that once-in-a-generation opportunity energy. That doesn't make you untouchable. It makes you less exposed. And in financial markets, being less exposed than the average investor is a real edge. Quiet, compounding, and incredibly valuable over the long run. Because this story isn't over. OpenAI is gearing up to go public. With a governance structure that has no precedent in the history of the American public market. With a business model that depends on costs growing faster than revenue, and with a valuation pricing in a future nobody can guarantee. When that IPO arrives, and it will, every single question we asked here comes back, with more urgency, with bigger numbers. The next video is already showing up on your screen. In it, you'll understand why the OpenAI IPO could be even more dangerous for the retail investor than SpaceX, and what separates those who'll come out ahead from those who'll be left holding the loss, worth every second.